There's two things that bother me about the Fed's reaction to these inflation figures. Number one is timelines that aren't being considered, and number two is lag times that aren't being considered. Good morning, welcome to Sunrise Small Talk, episode number 6. I'm your host, Andrew Hoffmeyer. We are here in the office today. Time is 5:54, and it's 68 degrees. We're going to talk about inflation, we're going to talk about the Fed's response, and ultimately we're going to talk about how that affects your money. I've got a very simple idea that I'm going to share with you, a demonstration that's going to involve these cards on my desk. It's going to take a complex scenario, and I'm going to make that relatable for the common individual, so you can really understand this relationship between interest rates, the Fed's response, and what the market is doing about all of that. So first of all, we had some very important economic data come out this week. Number one, CPI report came out Tuesday. That's the inflation report. Came in at 7.1%. So that's down from our high of 9% over the summer. So that's good. Inflation, we don't want 7%, but that's a lot better than 9%. The Fed then came out on Wednesday and gave us their update on the Fed funds rate. They increased another 50 basis points to no surprise. There's about a 95% chance of that happening. So here's the issue. They're being so aggressive or hawkish, as it's called. Dovish is a low interest rate Fed environment. Hawkish is when they're raising rates, sucking money out of the economy. Last time they were hawkish was 04 to 07. If we remember, it was 25 basis points. They raised something like 15 out of their 17 meetings, 25 basis points, which means 0.25%. Pretty slow and gradual. It took about 18 months. Now, we're seeing 75 basis point increases. The Fed funds rate was 0 on March 1st. It's now December, and we're at the 4.25 to 4.5 range. That's a little aggressive to combat inflation numbers that are still single digits. They're not good numbers, but they're not double digits. They might have hit double digits if the Fed didn't take action, but they're being incredibly aggressive, in my opinion, with these rate hikes. And I don't think they're factoring the lag time. Once they start increasing interest rates, the economy slows down, but it doesn't happen overnight. That's one of my gripes. Number two, my second, and this is probably the bigger gripe, is we don't consider the timeline. It's important to know how inflation is calculated. It's calculated every month, and it's on an annual basis. So what I mean by that is this report we just got in December looked at November 2022 relative to November of 2021. Our basket of goods, so in the last week, we bought tires for my wife's Jeep. We bought some household items at Target. Of course, we bought groceries. All of those things go in this basket. The basket is calculated every month. And on average, that was 7.1% higher November of 2022 than it was November of 2021. That's where our 7.1%. That figure, that hot figure was 8.9, 9.1, something like that, summer of 2022. So right now, we're just going to say 2021 to 22, 7%. Not a good number. Certainly, the Fed needs to take some sort of action if we're going to have 7% and 9%. And here's the problem. What I see as the problem. 2022 to 2023. We're all going to go shopping in March. And that basket of goods in March of 2023 is going to be measured relative to the same goods in March of 2022. March 2023, we're going to look back to March 2022, and we're going to have a number, a percentage. How much more did that stuff cost? I'm going to argue not much. Especially when we get into June, July, and August of 2023, I think that number is going to be a very small single-digit number. Now, if we look at these numbers relative to 2019, yeah, they're astronomically higher, but that's not how we calculate it, and the Fed responds to those current numbers. I think we'll see this sharp drop-off in the CPI reports starting hopefully in January, but it may be more like February, March, and no one's talking about that. I think that's something important to talk about. So what I'm going to do to demonstrate all of this as opposed to writing numbers on a whiteboard is I'm going to set up a little racetrack and give you a demonstration and a really easy to follow visual for how this all works. Here's our racetrack. This is the US economy. This is your retirement. This is everything we talk about when we're in my office. I better move this coffee because this race is going to be a good race. Does anybody else's wife buy their husband's cars for Christmas? I'm a child in some senses. My wife doesn't hesitate to remind me of that. This is our racetrack. These cars represent different things. Right here we've got a red Corvette C8, the red car, a white Shelby Cobra, and a blue Ford GT. Red car, white car, blue car. The red car is inflation. When inflation goes up, that's the red car putting on the brakes. The white car is the Fed. When the Fed increases interest rates, that's putting on the brakes. This relationship in normal times is pretty standard. Think of going down I-25, you get closer, you get some distance, so on and so forth. You're going 75 miles an hour, everything's great. Off to the side, we have the blue car. This is the market. This is your money. The blue car watches this scenario play out, and I don't care what anybody says, these are the only things that matter. This is when you make money, this is when you lose money, this is all that matters. The market watches this relationship. For the last decade, 2019, even in 2020 and 2021, after we pumped the economy full of dollars, which is essentially like giving a car accident victim morphine, we're cruising along going 85, 90. There's maybe some talk about some inflation. No one really cares. The Fed's like, this is awesome, we're doing double-digit returns. The Fed comes along and everybody says, well, there's all these dollars in the economy, that means inflation. But there is no inflation yet. Red car's cruising. Fed says inflation's transitory. That's not even the right word. First of all, transitory means one place to the next. What they meant to say was transient, which means it's here today, gone tomorrow. It certainly was transitory. It went from good to bad, one place to the next. Not transient, here today, gone tomorrow. So they're cruising along thinking things are transitory, in their words, transient, in our words. So we've got a little inflation, they say it's gonna pass, and they're going full speed. They're still going 85, and the red car's now going 65, 55. Red car stops, Fed slams on their brakes. Rapid rate increases, month by month, 75 basis points at a time. We were at 0 in March, and now we're over 4, and they expect it to be 5 going into next year, and there's no talk of them slowing down. They're hawkish. Hawkish means aggressively tightening the economy. White cars putting on the brakes. Dovish is what we like. Dovish is they're cruising along at 75, 85 miles an hour. The market is a leading economic indicator. So the market saw the Corvette slow down, sits back here, and says, this Shelby Cobra is going to have to slow down. We don't like it. We're slowing down. We're going to let them figure their stuff out. We're going to hang back here. So we've seen the market pull back in the last 12 months pretty significantly. We felt it. Market's back here. Red car slamming on the brakes. Fed slamming on their brakes. Now what happens in this exact scenario when you're driving on the highway? Eventually, we all stop. The market has stopped. White car stopped. Red car stopped. We all stop. Now the front car starts to go. And then in a normal environment, the white car starts to go. What we have right now, we've seen inflation go from 9 down to 7. The red car's starting to move. It's going 30, 35. Hopefully picking up some momentum. The white car is still sitting here saying, we're not only going to stay stopped, we're going to push on the brakes even harder, increasing interest rates. The market is saying, I don't know what's going on. I'm just going to hang around this minus 18, minus 20, minus 22% because I don't like this scenario that's playing out. Now, a market, being a leading economic indicator, needs to see inflation be a little more normalized. The Fed talking less hawkish and more dovish, talking about getting the motor started again, not as much about raising rates. Once the market sees that, we should, all things equal, see the market take off. And that's my two gripes with the Fed. Number one, there's this lag time. This car puts on its brakes, we put on our brakes, and they're not accounting for that lag time. They're not taking their foot off the gas and saying, okay, let's let this play out. Let's give it 6 months or 12 months. And that's okay. That's just what the Fed does. That's normal. I'm not telling them they should do something different because they're not gonna. It's just the way it works. They're too afraid of the inflation getting out of control. Until we see the Fed ease off the brakes and someday put their foot on the gas, our market's gonna hang back here. And like I said, my opinion, the problem I have is the timeline of this. We're going to start seeing numbers in January, February, March, those inflation numbers. They're not going to be 9. They're not going to be 7. Maybe I'm wrong. If I'm wrong, you can all call me and tell me I was wrong. But I see those numbers, and I think you would agree, after looking at it from a big picture, those numbers, when we go shopping in March of 2023, that's not going to be significantly more expensive than it was in March of 2022. Let's throw a crazy number out there. Let's say inflation is now 2, our red car's now going 75 miles an hour. The Fed is going to have to play catch up. Maybe they're going to say, well, shoot, now we're going to reduce rates. We're putting our foot pedal to the metal. Who knows how it will play out? Unfortunately, this is where we sit now. The red car's taking off a little bit. The white car is slamming on the brakes, and the market is saying, I don't like what I see. I'm hanging back here. Have a good Friday. Hope you enjoyed this. I think it's something that you can tell this story, you can share with people because we all drive. It makes sense. Feel free to forward the email if you have any questions or if you want to come in the office and race cars. Let me know. My office mate, his name's Greg. This is his car. These are my 2 cars. We're both children apparently, and there was one week where our wives were out of town and we actually stood up front and raced our cars on the reception desk because no one else was here but us. His car always wins.